So today I'm going to do a full portfolio update. I'll go through all my portfolios, show how they're doing, what I'm thinking of changing, what I'm keeping the same. And you'll know from my previous videos this year that I do have a set strategy that I'm sticking to, the ETFs that I'll be investing into. But I do also have those legacy investments, so to say, that still do exist in the ISA that I have to decide, am I going to keep them and just not contribute to them anymore? Am I going to sell them and just make the portfolio simple? And basically the strategy that I want to stick to going forward. As always, before we dive into it, I want to make clear why I do these portfolio updates. I do these updates because I find it super interesting to see how others invest. And also I think by seeing other people invest, it just makes it feel more real. And I do hope we can build up a bit more of an investment culture in the UK because not enough people invest. And investing is one of the most powerful ways that we can achieve our long-term financial goals. And that links to the disclaimer. Yes, there's always risk with investing. It's volatile. The value of investments can go down as well as up. And this is not investment advice. What is suitable for me may not be suitable for you, and I'm not a financial advisor, so please always do your own research. So a bit of context about what's been happening in the market. So over the last month or so, we've seen a lot of high valuation growth stocks in the market take massive hits. Palantir is one such example that's been on a tear over the past couple of years. But in the last month or so, it's taken a big hit alongside a lot of other high valuation growth stocks in the market. And there's a few reasons. You could say that some people saying this is because there's fears that software companies are going to be impacted by AI. There's other people just saying that it's to do with the valuations. And I kind of lean more into that point of view, whereas valuations can only go so high before there has to be some form of correction. And these stocks trading at incredibly high valuations, having a 10 to 20% correction, just seems healthy to me every now and then. But what this has reminded some people is that if they don't have a diversified portfolio and they only have a portfolio that tilts towards a certain type of stocks, in this example, growth stocks, high valuation stocks, they will have seen a massive hit to their portfolios over the past month, whereas people who've had diversified market-wide portfolios will have not really felt a hit at all. And in fact, I do think a global index is still up year to date. And also, another section of the market, value stocks, have done incredibly well in 2026 so far. So we kind of have seen a rotation in the factors that are now in favor. The value factor is now in favor at the start of 2026, and value was also the top performing factor in 2025. And it's really interesting to me because suddenly we have loads of people wanting to tilt away from the US, overweight emerging markets, overweight developed world ex-US, and certain sectors that people found really boring and wanted to completely avoid and said there was no growth. Now everyone's talking about certain ETFs like the FTSE 100 or UK dividend funds or emerging market funds, whatever it may be, and specifically active management with value-focused picks, active managers that have a value portfolio. These are all funds that previously, a couple of years ago, everyone just completely wrote off and said that, oh, the UK is dead. Why would you want to invest in the UK? Value investing is not returning. There is no value premium. And it just is a reminder of me recently of how quickly market sentiment can change, how quickly investor behavior can change, and people just react to whatever's going on. And it just goes back to how I think about the market nowadays is that factors, styles, themes, sectors come in and out of fashion. I can't really predict it. So going forward, the things that matter to me are diversification and making sure that any tilt in my portfolio or my portfolio at all is a portfolio that I can stick with. Because I believe that I can't time which factor is going to do well, I want to make sure that my portfolio is one that I can stick to over the long term and just for the most part switch off. And I did just find it interesting to see recently how these certain ETFs, certain factors that people have hated on for so long are now doing well and now suddenly everyone's talking about it. But let me know your thoughts on that in the comments below. And the last thing I want to mention here is that on my ETF cheat sheet, you can see on the leaderboard year to date, at the top of the leaderboard on year to date returns, it's all of the value focused ETFs, either outright value funds that have it in the name with deliberate value tilts, or ETFs that just happen to be value focused. Like a FTSE 100 ETF isn't designed to be a value fund. It's just that the FTSE 100 is dominated by the value stocks, basically stocks that have low valuations relative to the rest of the world. You see dividend funds at the top as well, and this is nothing to do with the fact that they're dividend funds. It's just that dividend stocks tend to also be value stocks because a higher yield is one measure of value. If you want to check out my ETF cheat sheet, I'll leave a link in the description as always. You can sign up and get free access. So here we are in my portfolio now. I'm using Getquin to aggregate all my portfolios in one place. And if we go to the year-to-date chart, we can see year-to-date I'm up by 1.1% or £850. So as I say, that's just because I hold a diversified portfolio, so I haven't really felt that growth section of the market being hit. But that doesn't mean that all my portfolio hasn't been hit. I will show in the video that certain parts of my portfolio have reflected that big hit in the high valuation section of the market. So we're going to focus on my SIPP here on Getquin first, because we'll take a deeper dive into my ISA afterwards. So on my SIPP, I now just hold vast majority in a simple global index tracking ETF, in this case, the SPDR MSCI All Country World Index ETF. And then I did sell my US small cap ETF that I held as well and replace that with the Avantis Global Small Cap Value. And these tickers here, just ignore these tickers because Getquin is a European app. It's using the tickers for the Euro listed versions. I have the GBP listed versions, but it still tracks just right. It's just how Getquin displays it here. It shows the European tickers. So with my SIPP going forward, it's mainly going to reflect my ISA as well, in the sense that I'm just going for a globally diversified portfolio with that small cap value tilt via the Avantis ETF. And I went through my thoughts of why I'm doing this in my recent video. But yeah, simplicity is just the name of the game for me now. I've just decided that's just what works for me. At the moment, I am building up my global small cap value position, mainly in my SIPP, until that's a bigger part of the portfolio, and then I'll start contributing to the standard global ETF as well. And if we just go into the asset allocation for my SIPP, we can click show more, and then I will go to the regions. So my SIPP is currently 64% North America, 12.6% Europe developed, then Japan, emerging, UK, and so on. So you can see it is heavily dominated by the US, but that is to be expected because I've got a global ETF that contains both developed and emerging markets. That's about 60% US at the moment. And then I also have the global small cap value, which is basically a developed world. It's called global, but it's actually just a developed world small cap ETF, and that'll be about 70% US. So that's how I get to that US allocation. I know a lot of people are nervous about a lot high exposure to the US at the moment, but because I have a long investing horizon and because I want a simple, diversified approach and not worrying too much about things like that, I'm just keeping it with roughly market cap weights. I'm not thinking too much about it. I understand that for some people, they do want to underweight US, but just because of those things I said in the introduction and my investing style going forward, I'm not really giving it too much thought. Okay, moving on to my stocks and shares ISA, and I'm on trading 212 here on the asset allocation. We can see that my current positions in my ISA are up. Unrealized result, £6,300. So unrealized result here on the asset allocation just includes the gain or loss on your open positions. It doesn't include realized gains from previous positions you've held or dividends or interest. It's just from your open positions, what the profit or loss of them is. And you can see 61% of my ISA is in the same global ETF I have in my SIPP. And then I have JP Morgan Global Growth and Income. This is an investment trust. It's actively managed. Over the past year or two, it hasn't done too well, but historically it does have a pretty good track record. But as I say, recently it hasn't done well. It's called Global Growth and Income because it aims to provide growth and income. And the next dividend is on the 9th of April, 6p per share. So this is one of those things I'm just not too sure what I'm going to do with going forward because I want to simplify my portfolio. In that sense, it would make sense to get rid of it. It's also actively managed. And given my general thoughts on active management, it also is another reason why it doesn't make sense why I'm still keeping this. So it's one of those things where I'm being irrational as an investor here, because if I was being rational based on what I believe and what I think, I would just get rid of this. But I have that. I'm just being completely irrational. I'm keeping it at the moment, and who knows, I may sell it soon. But it's one of those things where I'm human and I don't really know why I'm keeping that. And I guess it's that irrational fear that I sell it and then it starts outperforming again. And that's just a pretty silly reason to not sell it. But I think it really is that. And I'm being completely honest there, because I could say that I've got some thorough reason for keeping this. I just don't. I'm being irrational. And I guess it is just that fear that I'll sell it and it starts outperforming again. Then next we have my Avantis Global Small Cap Value ETF. That's been absolutely soaring recently. As I say, we've had that rotation into value. I'm not timing the market with this. I just happened to build up this value position in my portfolio at the same time it started to do well. That's pure luck. And to prove that's pure luck, a couple of years ago, I actually held a MSCI World Value ETF, and I sold that just before the value factor started doing really well. And so I'm not good with timing factors at all. It's just this time I've got lucky with building up that position. And this really is more now of a longer term hold that I'm going to try crack that behavioral side and ride with it through the ups and downs. I understand that value comes in and out of favor. There's no guarantees. Over the very long term, I might have been better off with just a global index than not even borrowing the small cap value. But it's what I've decided to do based on my research. and balancing that interest in investing, wanting that research tilt, but also having something that I can stick with. And then we are on to the smaller positions. Scottish Mortgage Investment Trust, that's actively managed, contains both public and private companies. It's just a small bit of fun in the portfolio. The same with the Wisdom Tree Global Quality Growth. That tracks an index, but it's an index designed by Wisdom Tree. And the way I try to think about this one is it's basically like a slightly more global version of the NASDAQ 100, but in practice, it does behave a lot like the NASDAQ 100 because of the weightings. If we look into it and scroll down, you'll see like it's slightly different to the NASDAQ 100, but it's a lot of the same names that are in the NASDAQ 100. And yeah, it's performed well recently, but it has also taken a hit over the past month. But over the past year, it's done very well. It's one of those ones that I got very lucky with the timing with. If we go on the 1 year chart, you can see I bought it right at the bottom of the Trump dip last year. Pure fluke, but it's done very well, apart from that hit with growth stocks recently. So these are other parts that I could sell to simplify the portfolio, but they're relatively small and they're less of a headache than JGGI for me, because JGGI is quite a big position. So in terms of simplifying, that's one that I'm more thinking about getting rid of. But Scottish Mortgage and Wisdom Tree, they're kind of just small parts of the portfolio that just satisfy that itch to experiment with other things. They're not really something that they're big enough that they're going to have a major impact on the portfolio. And they're diversified. I'm happy to have them, and I've got no plans on selling those two at the moment. Lastly, now onto my individual stocks. And thankfully, I'm not a stock picking guru, never claimed to be one, because otherwise this would be embarrassing. Yeah, all my stock picks right now are doing terribly. Especially Adyen had a massive hit after their recent half results. Grab's taken a hit. Bloomsbury's not doing too well at all. Yeah, across the board, it's not doing too well. And some of these are growth stocks, high valuation stocks. Some of them just had poor results. And yeah, it's just another reminder for me of I'm not behaviorally cut out for stock picking, because if I had these and this was my full portfolio of these stocks, I just couldn't do it. If I woke up one morning and seeing Adyen's results and I had a sizable part of my portfolio in that, I'm just not cut out for it. And fair play to all those stock pickers out there that have the nerve and can stick through the results like this. I've just realized I'm just not that interested in results, and I'm not good at stock picking. From a research perspective, I think that most people will underperform the market with stock picking. And yeah, I'm not behaviorally cut out for it. So yeah, it's just another reminder for me that I will always be mainly a diversified ETF investor. And yeah, fair play to those stock pickers. I'm not preaching here. I do sometimes worry that I feel like I'm preaching with my style of investing. I'm not preaching. I'm just trying to get across how I think about investing and what I've done that works for me. Everyone can invest however they like. I just want to give my perspective on what I'm doing. So that's all my portfolios. The only thing I've not shown here is my general investment account and lifetime ISA. There's really not much in there. I think a couple £100 between them. So yeah, there's not much point showing them. I think the key message of this video, the key thing I want to get across is that I am a completely irrational investor sometimes, where I've got this strategy with my contributions going forward, but I've got these older positions in my portfolio that I can't let go of. And it's strange. And I'm just thinking, do you have that? If you've changed your strategy of investing, you've changed your beliefs, do you find it difficult to sell those previous positions in your portfolio? I'd love to hear about that. It's just interesting to me, and I've never claimed to be the perfect investor. And with these portfolio updates, I just want to show that over the couple of years that I've been doing this channel, you'll see that my strategy has changed. My contributions, of course, changed with income going up and down, expenses going up and down. And that's the reality of investing. Very few people get it right and they're able to contribute a consistent amount. Life changes, your experience changes. And I do think the one thing that I've just come to believe, that investing can be as simple or as complicated as you want it to be. You don't have to watch finance content. I'm going to do a separate video on that, but I did have a comment recently with saying that you don't even need to watch finance videos and you can make investing simple. You could just contribute monthly into a global index, and then hopefully in 30 years' time, you'll wake up and you've got a significant portfolio and you can retire. And I completely agree with that. You don't have to have an interest in investing. You don't have to follow it. And there's a lot of noise. So just be careful with what you watch. And I think one of the best signs that you're watching the right content is someone's not 100% certain, unless it's something basic where it's just a factual thing. If someone's confidently telling you that they've got the best strategy and they know it's going to outperform, buy the dip, buy this particular stock, or diversification is a lie. I hear that sometimes. If people are confidently making statements like this, run a mile, in my opinion. Anyway, topic for another video. As always, thank you for watching and let me know your thoughts in the comments below.